Hi everyone. Welcome to our webinar on Equity Strategy 2024. So as you can see on the screen, we are quite bullish on the equity markets this year. I will be discussing what are the reasons why we are bullish on the equity markets and what are the contributory factors to it. So looking back at our history, so we are coming out of sort of, rough years, couple of rough years. So even though we are not completely out of the woods yet, we are sort of stepping into a year with relative normalcy. So with that and with all the macro indicators and other indicators heading towards, sort of a normalcy, we are quite bullish on the equity markets. So we have designed this presentation under 3 themes. So these are the themes that or the reasons why we are bullish on the equity markets. The first one is being the unlocking the liquidity. So within recent couple of weeks also, we have seen that liquidity infusion or the liquidity increase in the equity markets. And also, what are the other contributor factors for this liquidity growth, that we are expecting in the upcoming months. And the second one is of course, the recovery of corporate earnings. As I said, since we are stepping into a sort of a year of relative normalcy, we expect corporate earnings also to grow up compared to the last couple of years. And the last but not least, the last one is the turn of sentiments. So if you look at the sentiment from the consumer sentiment and the investors' perspective, we are coming into a sort of a election year. In a year like that, how the consumer sentiment or the investor sentiment reacts. So we are trying to dig deeper and discuss about these 3 themes. So according to our calculations and our expectations, we expect the ASPI, the peak range to be between 12,500 to 13,500 this year. It won't be like a straight line as depicted here. During the year, somewhere down the line, we expect this peak range to hit in our Colombo Stock Exchange. So yeah, coming into the first reason, the liquidity unlock. So as we have seen, the liquidity is being increasing during the last couple of weeks. What makes this shift? So one reason I have mentioned here, what you can see is the blue color line is the 1-year treasury bill rate, and the green color line is the ASPI. So historically also we have seen this relationship where the interest rates are reducing. The ASPI or the Colombo Stock Exchange is performing really well. So now also this shift has taken place, whereas we have seen the interest rates hovering around 30% during 2022 and the first part of the 2023. And now that the interest rates have taken a hit or the plummeted, so we are witnessing the market is activating or reactivating right now. And we expect this momentum to continue as we expect the low interest rates to prevail for the next upcoming couple of months or quarters. So one reason is that if you look at this chart, the pie chart, what you are seeing here is the maturity analysis of the banking sector deposits. The light blue color one, the blue color portion is 32.1%, which is the CASA or the current accounts and savings accounts. Which is literally bearing no interest to about 3 to 4% interest maximum. So the second part of it is the 20% of the pie. So which is less than 3 months deposit, which are the deposits maturing within 3 months. So the next one is the 36.2% portion, which consists of deposits which are maturing below 12 months and above 3 months. So which consists of 6 months deposits as well as 12 months deposits. So these figures as of December last year. So these 3 months deposits and part of the 6 months deposit would be maturing right now. So these people or these investors would be out there in the market in search of better returns. So obviously, equities is one of the better options right now, whereas other fixed income investments or the options are, delivering very low returns right now. So if you look at the entire deposit base or the entire deposit base of the banking sector, it is amount to like 16.6 trillion right now. So even just a 1%, which is amount to like 1.6 trillion comes to the equity markets, it is substantial enough to make a huge difference or to boost the liquidity to a significant extent. So on the right hand side to you can see when the AWFDR or the average weighted FD rates started coming down, the deposit growth rate has also fallen. So as I said, these deposits, when they are maturing, we expect a portion of it, at least a small portion of it, to flow into the equity markets, which would help to boost the liquidity in the market overall. So another reason, okay, let's say you are a very conservative investor, or the higher the risk, higher the return. The equity market, of course, involves some sort of a risk. So if you are a very conservative investor, or also you are a long-term investor with minimum to zero knowledge about the equity markets, still there's an option that you can recreate a fixed income portfolio within the equity market. How do you do that? I think you have heard the dividend yielding stocks are there, where there are like 15 to 20 odd stocks are there, very conservative with their dividend policies, which are giving 10 plus returns. Here, what I have mentioned is the light blue color bars are the top 10 dividend yielding counters. So I have given figures for a couple of years. So, if you are having a fixed deposit, let's say for an example, you are having a fixed deposit, and if you are earning more than 350,000, so you will be liable for tax of 36%. So if you, for an example, let's say the current running fixed deposit rate of the banks are like 8 to 9% in a private bank and 7 to 8% in a government bank. So let's take 8% as an example. If you adjust your 8% interest income to the 36% of the income tax, you will be effectively getting, or your real return would be like 5%. So currently the inflation is running around 4 to 5%. So is that, additional return of 0.5 or less than 1% kind of a real return is enough for you to invest in fixed deposits? So in that sense, and also what you can see here is, dividend income. On average, last couple of years, top 10 dividend yielding counters has overperformed than the tax adjusted fixed income securities or the fixed deposits. So in that way also, you can, as I mentioned, you can recreate a fixed income generating portfolio through the equity markets. So another place where the liquidity has moved during the last couple of years, we have witnessed and we have seen there's a lot of money printing happen during the last couple of years to source for the deficits, to source the fiscal deficits we have seen. So during that period, we have seen high inflation also because of these factors. So you can see clearly in 2022, there's a huge jump in government securities. What I have mentioned here is the investment by local individuals in government securities, excluding the bigger funds. So even in the retail market, we have seen this huge increase in the investments in government securities. So as I mentioned before, a part of these investments would also flow into the equity markets right now, that the yield pattern is reversing right now. So comparatively, it would be advantage even if you exit from these kind of government securities and invest in equity markets right now. So moving on, another reason, corporate action. So if you look at last 2 months, March and April, so the dividend, this is sort of the dividend paying season. So the dividends, the total dividends that have flown into the market or else to the public holdings is amount to like 20 billion. So these are from the actual figures. So out of this 20 billion, a portion should be reinvested. Historically also, we have seen these patterns. Portion is, reinvested in the equities itself. So with that coming in, and again, on the right-hand side of your chart, of your screen, what you can see is the blue color bars are the periods where the Expo Lanka's parent company, ST Holdings, has bought back shares in the market. So during those periods, those share buybacks has happened, we have witnessed the market turnover has increased significantly. So now that you all know the Expo Lanka delisting deal has gone through, it was approved. So those funds would also flow into the market in a couple of months. So, the total sum would be about 60 to 70 billion. So out of that, around 35.8 or 36 billion would be for the public holdings. So out of this 36 billion, even a small portion, even 5-10% would be enough to, boost the liquidity in the equity markets. So these are a couple of reasons that why we expect the liquidity to, sustain and keep going up, keep increasing in the equity markets in the upcoming months period. So the second reason is the recovery of corporate earnings. So as I said earlier, so we are coming out of a couple of rough years. Now with the normalcy, we expect, and we have witnessed sort of, if you have went on shopping during last festival season, you might have seen a little bit of difference compared to the last couple of years, maybe. COVID pandemic, continuous back-to-back issues, economic crisis. After that, maybe this quarter, according to our channel checks as well, we have seen sort of a decent season. So with that and reasons like, interest rates coming down, finance costs being lower, with all those factors taking into considerations, and according to our calculations, we expect around 15% at minimum corporate earnings growth in 2024 year on year. So out of that, the banking and finance sector, we are sort of bullish on banking and financial sector. What are the reasons? So we don't expect a big jump in, the loan books or loan growths in this year. And also we all know that the interest rates are coming down. With that, net interest margins or the NIMs are contracting in the banking sector. However, compared to the previous years, we won't see that kind of big impairment expenses in these years, starting from 2024. Two reasons. One is, if you look at the NPL figures from the first quarter of 2022, you have seen a continuous improvement in NPLs in the banking sector. And in December and January, you have seen, it's sort of plateauing and started to decline or started to reducing. So with those NPLs reducing, we don't expect, additional or incremental provisions from the NPL front. And from the other side, the ISBs. So from the banking sector, according to our chats with the banking sector top officials, so almost all the banks have increased their provisions to about 50 to 52% right now. So with that, and according to our calculations, the present value loss, NPV loss, or the day one loss would be a little bit lower than this. So in that sense, we don't expect, the banks to increase their provisions from these levels. So overall, the banking sector impairment expenses, it won't necessarily be a reversal, but the incremental expenses or the additional impairment expenses in upcoming periods would be lower than the previous couple of years of quarters. So in that sense, that would directly trickle down into the bottom lines of the banks. In that sense, banks will be able to, maintain or increase their profitability in the upcoming quarters. So another sector is consumer goods. So, consumer activities, consumer staples, consumer retailing. We are quite bullish on those sectors. The reasons, you have seen these activities are increasing, activities are improving. Again, last couple of years with high inflation, we have seen, the additional burden, customers' wallet pressure. Due to those reasons, we have seen those consumer sentiments were diminishing. And now that, people are gradually started to accepting those price levels and adjusting their income levels. Right now, we know in many companies, private sector companies, they're adjusting their salaries and benefits during the months of March and April. So with that, there will be a little bit of additional, discretionary income portion kicking into the, consumers. So with that, and going forward, we won't see major increases in prices or major volatilities if we sustain this normalcy. So with that, we expect, consumer segment to recover first in the cycle. So of course, it is a cycle. So at the inception of the cycle, it would be consumer necessities or consumer staples or retailing activities. Afterwards, we would gradually see the, interest coming into the other discretionary items like, beverages, soft drinks, ice creams, those kind of stuff. And towards the latter part of the cycle, maybe tobacco, alcohol products, and other electronic items maybe. Yeah, and again, the tourism sector, another one key sector that we are bullish on. So we have seen, we have witnessed after a couple of double, triple whammies, maybe after the Easter Sunday attack, COVID pandemic, and then economic crisis, we took a major hit from the tourism front with low tourist arrivals. But yeah, during last two seasons, we have seen it's recovering. Even during last 3 months, we have seen, tourist arrivals exceeding 200,000 levels. And of course, we are coming sort of into a low season after April. There will be a little dip, but still we are bullish on the tourism sector year on year. Even, it doesn't have to necessarily be a direct impact for the tourism counters like hotels and stuff. But the additional income that would trickle down to the general community or the people who are around doing, when small vendors and small, shops and stuff around the coastal areas where the tourism activities are happening, those income streams would trickle down to these sectors, those small communities. So that will, indirectly coming into the consumer spendings. So in that case also, again, it would be beneficial for the consumer goods sector. So yeah, that is from the fundamental side. So if you look at from the valuation side, so right now the market is trading around 10 times of the PER. So according to our expectations of ASPI going to 12,500, 13,500 range, and with factoring the 15% kind of a income growth or the earnings growth in the corporates in this year, the PER should come down to 8.1 times. So in that sense, the 5 years average PER is around 9.9. In that case, the equity market would be lucrative to invest, and there's a there will be opportunities to gain. So what you see on your right hand side is the market capitalization and the adjustment, and this light blue color line is the market capital, and the dark blue color line is the inflation adjusted market capital. So you can clearly see, the gap between these two lines have widened after 2021 with the economic crisis. So, during inflation, all the prices of the goods and services are increasing and adjusting to the inflation. But here, we don't see that adjustment has happened to the equity markets or the stocks of the equity markets. So, definitely this should be corrected. We don't expect, these two lines to converge, but at least the gap should be minimized between market capital and inflation adjusted market capital. So as I mentioned earlier, the corporate earnings would grow by 15%. And we have seen this trend starting during last 2 quarters, actually. So after, quarter on quarter declines posted for like 5-6 quarters, we have started seeing this improvement from third quarter of 2023 onwards. So if you look at the last quarter, we have witnessed 99% year-on-year growth in earnings. But if you adjust to the extraordinary items here, like for an example, extraordinary items in counters like bill, LOLC, it amounts like 70 billion. So even if you remove those and adjust to the recurring earnings, you will see at least 13% kind of a year-on-year growth in the last quarter. So with that momentum and with the expectation and calculations, we expect that earnings to grow to that 15% region in this year. So another high frequency macro indicators that points towards this growth, the petrol sales. If you look at the petrol sales, it has plummeted during the shortage period in 2022, the first quarter rather. So after that, even though the prices have exorbitantly higher, so that those volumes has come to sort of historical average levels that we have seen in 2021. So those numbers are hitting those averages, and again electricity generation. So you can see there's a clear trend that electricity usage also increasing. That is a sign of the manufacturing activities also sort of normalizing, and part of this is contributed to the current El Nino impact as well. So the cargo operations also improving, and part of this is we can attributable to the Red Sea impact. So with the Red Sea impact, we have seen our port volumes have increased, ship traffic has increased, transshipment volumes has increased. So that situation also sort of normalizing, but year on year and compared to the historical average, we are seeing a sort of a growth in that side as well. And all the indexes, PMIs, if you have seen the purchasing manager indexes, manufacturing services, as well as the PMI for the construction sector also has improved during the last couple of months, which is falling above 50 number 50. So from the index, so with that also it is pointing towards a growth in the economy. And the tourism arrivals, of course, we have discussed. And the last chart, the paddy cultivation, these are details from the Ministry of Agriculture. From that also sort of, there was a rumor and people were feared there will be a shortage in crop. But according to the information from the ministry, there's no such a thing like that. So the crop is enough for the next season as well. So the Maha season will be starting soon. And, with that, we will expect sort of a normalized crop yield in the upcoming quarters as well. So those parts we have talked about from the top line perspective. So when we come a little below the income statement, we will be seeing these margins. So we will see sort of a positive margin impact for the corporates in the upcoming quarters or the periods. So if I take an example, a company like Haley's, which had a huge debt burdens as of December quarter, they had a debt total like 170 billion. Even 1% decline in, or the 100 basis points decline in these finance cost would amount to like 1.7 billion. So, that cost saving or the finance cost saving would directly trickle into your bottom line. So in that sense, your margins will be expanding in the upcoming quarters. Here also on this chart, you can see how the AWPLR has, flowed through these quarters, and the net finance cost of the companies which are listed on the Colombo Stock Exchange, except for banks and finance companies. So those figures also keep coming down, with that also that benefit directly trickling down to those corporates' bottom lines. So here also I have taken one example, like if you adjust fourth quarter's corporate earnings, this is the actual finance cost they have incurred during those periods. And if you adjust that finance cost to the current AWPLR, you will be seeing sort of a 20% kind of a growth. So yeah, so this factor will be directly impacting the bottom line in a positive way. So another factor, if you look at from the supply side, last couple of years we have seen a lot of supply side restrictions, disruptions and restrictions. There were so many import restrictions. Now almost all have come off except for the vehicles. So from the supply side, we don't see that much of an impact. And again, recently also we have seen the electricity charges also has revised downwards. So with that also, if we assume the price levels to remain the same, that impact would come into the margins, maybe EBIT margins of the companies. So from the Bloomberg Commodity Index also, you can see even from the COVID pandemic levels, which we have seen, the commodity prices are peaking around. So those commodity prices have come down to a greater extent, and we don't expect major volatilities from this commodities front as well. So with those factors, that would be beneficial for the corporate earnings as well as their margins. So the last indicator, which is the turn of the sentiment, everyone knows that we are stepping into an election year. So the presidential election might be held around November. So we have done this analysis to identify the trend of the equity markets behavior during those election cycles. So what we have mentioned here is the 4 presidential election cycles, and 6 months period leading up to those elections. So in all those instances, we have seen this, incremental performance in the equity markets during the period that is leading up to an election. But after the election, it can go either way. As you can see here, it is going up and here it is going down. Of course, it depends on the result and, who's being elected. So during the period, leading up to the election, of course, we are bullish on the equity markets. So part of this is contributed to the consumer confidence. So here, what we have mentioned here is the blue color, highlighted areas are the 6 months, that 6 months period, which is leading up to the election. During those periods, we have seen this consumer confidence index is jumping up. So what are the reasons? Partly due to with, the election promises, election related spendings, closer to the election, governments also implementing different projects, giving handouts, various things, and direct election related expenses. And in previous cycles, we have seen they were increasing some capexes also during these periods. Those things and those promises will trickle down to confidence index, and so that's why we have seen this consumer confidence is jumping up during these periods closer to the election. So coming up to the last section here, I don't expect to pick up individual sectors, but since we will be only providing those facilities or the top picks to our clients. So here I'm touch basing upon the couple of sectors that we are bullish on and the fundamentals behind that. So first of all, as I mentioned earlier, the banking sector, if you look at this chart, the circles, the green color circles are the historical average PBVs. and these are the current PBVs and the adjusted PBVs. So what you can see here is current PBVs of the banks are hovering below 6.6 times. So historically, if you look at the historical averages from 2014, the historical PBV is around 0.78. So currently we are running way below these levels, around below 0.6 rather. So we don't really expect this to go back to, historical levels, given the, macro scenarios and the changes that has taken place in the environment. However, even if you want to keep trading at these 0.5, 0.6 PBV levels, if you have a look at their net asset values, the banking sector net asset values are, at minimum growing at 6 to 7% year on year. So with that increase coming in from the net asset side, you will be able to keep trading at 0.5, 0.6 level, even with an increase. So another sector I have discussed this earlier, consumer staples and, consumer necessities and retailing stocks. So we are bullish on these stocks fundamentally because, as I have mentioned earlier, given the reasons that the consumer confidence is coming back, the consumption pattern is returning to normalcy, and even on the right-hand side chart, you can see the same store footfall growth to the CCS or the Keels. So it has been increasing around 15.7% last quarter. So even this happens, we have witnessed that the average basket value has somewhat declined. So the consumers, during an inflationary environment or during a crisis period, we have witnessed that consumers are strategically redistributing their, basket sizes and basket values. So to address this issue, many companies like Hemas and other, consumer companies have come up with different strategies. For an example, value for money products, sachet packets, those kind of small size products to suit your budgets. So in that sense, basket values have declined to some extent, but the footfall has increased. So even if you look at from the regional countries, the modern trade penetration is very high in other countries like Singapore, Thailand. So, but in Sri Lanka, there's still a very, good room to improve from the retailing side, as our modern trade penetration is very low compared to the general trade. So yeah, this is one sector that we are bullish on. And the other one is the dividend yielding counters. We have discussed this earlier as well. So here I have mentioned a couple of stocks that are giving more than 10% kind of a dividend and very consistent with, giving away dividends. For an example, if you take a counter like CTC, their dividend payout ratio is 100%. So they will be paying out literally whatever they earn to you guys investors. So, yeah, here also, as I mentioned earlier, tax adjusted basis also, there will be advantage, whereas, even you will get a capital gain on this. The capital gains are 100% tax free on the equity markets, whereas your capital gains will be taxed even on the government securities at 10%. So there will be a tax advantage as well as a higher gain compared to fixed incomes. So that is from the fundamental side. And when the markets are running, when there's a bullish run, we have seen, sometimes there are other counters, for an example, high beta counters, which are running outpace the fundamental counters in those instances. Here, I have mentioned a couple of, high beta counters to look at. Here, actually, you can remove Calty from this because just 2 years of trading data, and other counters with high beta. Here, the all counters are with betas over 0.85 levels, and the y-axis is the 12 months average daily turnovers. So this region with high turnovers and high beta counters, actually, if you have a look at historically, those counters have, outperformed or moved in line with the markets according to their betas during a very, good bullish run. So another trading idea to trade on this kind of a scenario would be, undervalued stocks. How you read this chart is your y-axis is the current PBV, current price to book value, and the left side or the x-axis is the deviation from the historical PBV's average. For an example, if we take the counter to your far right-hand side, the PMB, so how you read this is this counter is trading at 0.6 right now, and which is about 70% discount to its historical PBV average. So yeah, so those are the fundamental and trading picks from our side. And it brings to the end of our presentation, and I would like to open the floor for the Q&A session. So you can directly direct your questions to the question box. Counters. For an example, let's take CCS for an example, who is importing sugar to manufacture their beverages and ice creams. So they would be able to, import those material or inputs at a lower cost since the dollar price is lower. So in that sense, even if they don't want to, pass that benefit to the clients by reducing the prices, they will be able to expand their margins. Or in the other hand, if they wish to, reduce the prices to give the benefit to the clients, in that sense, they will be able to improve their volumes, and that would, help to increase their revenues. And another example would be the counters with dollar debts. For an example, companies like Dialog and a couple of hotel sector stocks, which have dollar denominated debts. So they will be benefiting from this scenario in the short run. So now that, let's say now the dollar rate is at 300, whereas we have seen around 330 in December. So you will be paying your interest based on current rate, which is 300. So you will be seeing that, exchange gain or that exchange benefit trickling down to you if you are a dollar debt holder. Someone is asking whether the exit point that since that the election is coming up. So as I mentioned, we are bullish during the period that is leading up to the election, but after the outcome with who's being elected, the result might be different. So either it can go up or go down. So it depends with the scenario. So what, for the moment, what I can say is, better to, trade during those periods. And if you are a conservative or long-term investment, you can see your costs and at correct time. And even for a long time, I don't think that would be a significant impact. But if you are a short-term investor or a trader, you should be mindful during those periods. We might see some volatility. Someone is asking my views on the NBFI stocks with lower interests and high gold prices. So actually, there's some different correlation between banking sector as well as NBFI sector with the interest rates. So we have seen when the interest rates declining, NIMs are contracting in the banking sector. But for a short run, in the near term, when the interest rates are declining, finance sector or the NBFI sector, NIMs are increasing to a certain extent. The reason is, they have their asset books or the, loan books and asset books are very different to each other fundamentally. So, and gold prices also going up. Yeah, that is a good point. So there are two sides of it. So one thing is, now that the interest rates are coming down, we have seen those, loans or some pawning advances, those kind of small facilities who have taken those facilities for urgencies at higher rates. Now that the banking rates are very lower, some of those portions are moving into the banking sector at very lower rates. Maybe personal loan rates are running around 13 to 15% right now. So, there will be a migration from that finance sector to banking sector in a short extent. And on the other side, the security or the, leeway would be improved from the gold book. So for an example, if you take an example, let's say you have taken a pledge of 100,000 worth of gold and given 60,000 as a facility. Now that your 100,000 worth of gold portion has gone up to like 130,000 or something, you have a spread. You have an additional spread. So your security would be improved. Either you can lend that additional portion to the the portion to the client back and earn some additional interest, or else you can, have that additional security with yourself. Someone is asking about the foreign exchange rate. So I'll basically say what are the fundamentals behind that. So what has happened during the last couple of months, if you look at our balance of payment is at a surplus. Right now, we are having, good foreign remittances hovering above 550 million levels per month. And we are witnessing tourism earnings of like 330 million a month. So currently our exports are amount to like $1 billion for a month, and imports are around 1.5 billion. So there's a 500 deficit from the trade angle. but that will be easily covered from the worker remittances and tourism monies, and there's a 200-300 million kind of a surplus as well. And again, that we are coming into a sort of a low season from the tourism angle. We would see some sort of a decline in tourism earnings. And also, if you look at the historical worker remittances, we have seen that dip has taken place, after March and April. Those are sort of seasonal months for worker remittances as well. So with that dip coming in, and again, the external debt restructuring will be, happening towards June or July if they successfully concluded the negotiations. So after that, we will have to service our debts. We will have to pay some, additional interest of like 80 to 100 million dollars per month. So with those coming in, there will be a little pressure on the dollars in the upcoming period. And again, now that the imports are very low, given the demand side pressure is very low. So going ahead with the given reasons I have shared during the presentation, with the consumer sentiment improvement, with those factors, we will see those import figures also jumping up towards the latter part of the year. So with that, we will see that pressure on the dollars coming in towards the latter part. So with that, we expect sort of, dollars to hover around 320, 330 range towards the latter part of the year. Someone is asking about the construction sector. So improvement due to the interest rates coming down. Yeah, of course, there will be a huge significant impact to all the counters as well as construction counters with the interest rate declining. So they were struggled to service their working capital facilities and run day-to-day operations due to high finance costs during the last couple of years. But consumer sector, I'm not too bullish right now. Not in the near term, but into the medium and long run, we will see some increases. And if you look at the PMI for construction, that also has improved. And right now we are seeing some construction activities coming into the picture, but those are not new activities. What's happening right now is, the government is resuming some of the halted projects, some funded projects like port authorities funded projects, container terminals. So those kind of projects are coming up. So those are just resumption of existing work, which we have halted during, the pandemic period and during the crisis period. So those completion work is coming up, but the large scale projects, which are funded by ADB or other multilaterals like World Bank, those are yet to come up because they all are waiting until the EDR is concluded and we get sort of a rating upgrade. So with those factors towards the latter part of the year, we will be seeing those improvement or infusions coming into the construction sector towards the latter part of the year, or rather in 2025. Someone is asking about access engineering. So okay, I'll touch base on the access a little bit. So from what I have seen currently, according to our discussions with the company, so they also witness some of these, the halted projects are being resumed. Couple of projects are in hand. So, the port projects and some of the, bridges and those kind of stuff are being resumed. So those kind of small to medium size, medium scale projects will come up, but there won't be any significant big new projects coming in for, next 2 to 3 quarters. So, yeah, very good question. What is your view on the international investor sentiment on the CSE? So actually the international investors or the foreign investor sentiment is really important to the stock exchange like this, like Sri Lanka, a frontier market. So foreign involvement is really necessary. Right now, we don't see that much of a foreign involvement. So historically, if you look at the foreign contribution to the stock market is around 32%. Right now, it is lower than 10%. So it is very low right now. And recently, we have had our South Asia Investor Conference with large fund managers from all over the world. From the discussions we had, it seems like they are sort of taking a wait and see approach right now. One reason is, as I explained, the external debt restructuring. They need to see a clarity from that angle. And the second reason is the rating upgrade. They are waiting to see a rating upgrade after the debt restructuring is completed. And the third reason, and the biggest reason, is the political scenario. So frontier countries like Sri Lanka, Pakistan, Bangladesh, there's a there's always been a volatility in policies when there's an election. So policies are being changed after a new regime is elected. So due to those kind of high risky concerns, foreigners are mainly waiting until the political fiasco or the election is over to the latter part of the year. So until that, we won't see that much of a foreign interest coming into the Sri Lankan market. Right now, the foreign interest from the frontier market, if you look at the east towards the Pakistan, because their election has been concluded recently. And if you look at their indexes and the market performance also, you can see how they are moving with the foreign participation right now. Someone is asking about the status of the banking sector's stocks in the upcoming quarters or the months. So as I said earlier, so we have seen there were some surveys done by central bank. The willingness to borrow from the customer side and the willingness to lend from the banking side both have improved according to the surveys. But we don't see that jump is coming up. The credit is not picking up that faster due to a couple of reasons, because the demand side is at a pressure right now. So we don't see that credit growth happening instantly. However, as I said earlier, even though there's a sort of a negative impact from the NIMS contraction and the slower pickup in credit, the positive impact that is coming from the lower impairment expenses, which is directly trickling down to the bottom line, we would see good results in the banking sector stocks. What is the view on the sovereign bond holders restructuring process? So the ISB front, and will it have a big hit on the share market? So it doesn't necessarily have a direct impact on the stock market because it is totally an external debt restructuring. So we have concluded our domestic debt restructuring successfully. With that, we have seen that domestic market, participants' sentiment has improved during the months of June, July last year. So we don't, foresee a major increase or decrease from the domestic angle after the completion or the, whatever the discussions heading towards through the ISB side. With that note, we would like to conclude our presentation for the day. So we will see you in a presentation like this in next time.